Hello traders, and welcome back to Explain the Charts. Today is November 16th, 2025, and we are doing a deep dive into one of the most watched pairs in the world, the EURUSD. We'll start by breaking down the current news and macroeconomic environment before moving into a detailed technical analysis of the charts. The current headlines paint a complex picture for the euro-dollar. A major theme is the diverging monetary policies between the European Central Bank and the U.S. Federal Reserve. The ECB's policy has remained relatively stable, with no immediate rate changes on the horizon. Conversely, the Fed's future path is clouded with uncertainty, a situation made worse by a recent U.S. government shutdown that delayed key inflation and jobs data. This lack of clear data has caused interest rate expectations for a December Fed rate cut to plunge, which has put some pressure on the US dollar. However, other reports suggest traders are now pricing out the chance of a rate cut, which could strengthen the dollar. This creates a push-and-pull dynamic that is keeping the pair in a volatile range. Analyst opinions are also split. Some sources, like Talk Markets, point to a strong medium-term downtrend, suggesting a potential drop towards the 1.1400 support level by the end of the year. They note the price is capped by moving averages, indicating weak demand for the euro. On the other hand, outlets like Forex.com are highlighting that bulls have emerged at a key trend support level, with the euro rebounding into the November open. This suggests a potential recovery is underway. Several key price levels have been mentioned in the news that we need to watch. On the downside, 1.1500 is a critical psychological level, with 1.1400 being a major target for bears. On the upside, initial resistance is being tested right now around 1.1641. A more significant resistance zone is identified between 1.1747 and 1.1775. Some analysts are even looking towards 1.1800 and 1.2000 as longer-term targets if a true trend reversal materializes. Now, let's turn to the daily chart and see how this news correlates with the price action. Looking at the bigger picture, we can clearly see the strong rally that took place for much of 2025. The price climbed steadily from the low 1.04s in March all the way to a peak of 1.1918 on September 17th. This was a very strong and sustained uptrend. However, since that mid-September high, the trend has decisively reversed. We've been in a clear downtrend for the past 2 months, characterized by a series of lower highs and lower lows. This aligns perfectly with the news reports describing the recent bearish sentiment. The price broke down through several support levels during this period, including the 1.1800 and 1.1700 handles. The selling pressure culminated in a bottom forming in early November, with the price hitting a low around 1.1472 on November 4th. This level acted as significant support, and from there, we've seen a sharp rebound over the last 2 weeks. This bounce from the lows is what the more bullish analysts are pointing to as a potential trend reversal. The price has rallied nearly 200 pips from that November low. Currently, the price closed Friday's session at 1.1619. This places it directly in the crosshairs of that initial resistance zone we discussed from the news, right around 1.1641. The market is essentially at a decision point after this strong 2-week rally. Will it break through resistance and continue higher, or is this simply a relief rally before the next leg down? Let's zoom in on this daily chart to get a better perspective on the recent downtrend and subsequent bounce. I'm filtering the chart to show the price action from the September 17th peak. You can see a well-defined downward channel that has contained the price for the most part. The recent rally started after the price touched what could be considered the lower boundary of this channel, combined with horizontal support around 1.1470. The bounce has been impressive, breaking through the minor resistance at 1.1500 and 1.1550. Now, it's pressing up against the upper trend line of this channel, which also coincides with the horizontal resistance zone around 1.1640 to 1.1650. This confluence of resistance makes the current price level extremely significant. A decisive break and close above this channel would be the first major signal that the downtrend is losing steam. Conversely, a strong rejection from this area would suggest the bears are still in control and that the path of least resistance remains to the downside. To get more detail on the structure of this rebound, let's switch over to the 1-hour chart. This view shows us the price action since late October. We can see the final push down to the lows in early November, followed by a clear shift in market structure. Since November 4th, the pair has been forming a series of higher highs and higher lows, which is the classic definition of an uptrend. This confirms the rebound we saw on the daily chart is technically sound on a shorter time frame. We can identify an immediate support level around 1.1580, which was an area of consolidation before the most recent push higher. If the price were to pull back, bulls would want to see this level hold to maintain the bullish momentum. The price action on the 13th and 14th of November shows a strong impulse move up, followed by consolidation. The price is currently consolidating just below that key 1.1650 resistance area. This tightening range suggests that energy is building for the next move. Volume has been consistent on the up moves and lighter on the pullbacks, which is generally a bullish sign for the short term. However, the pair is struggling to make a new high, indicating the presence of sellers at these levels. This hourly chart really emphasizes that we are at a critical inflection point. Finally, let's drill down to the 15-minute chart to analyze the most recent trading sessions from last week. Here we can see the price action from November 11th through the 14th. On November 13th, there was a very strong bullish move that took the price from below 1.1580 to a high above 1.1650. This was a significant breakout on the intraday charts. Following that strong push, the price action on Friday, November 14th, was largely sideways. The pair traded within a range bounded roughly by 1.1606 on the low side and 1.1654 on the high side. This is a classic consolidation pattern after a strong move. Traders are likely waiting for a new catalyst before committing to a direction. A break above the 1.1654 high from Friday would likely attract more buyers for a run at 1.1700. A break below the 1.1606 support would signal weakness and could lead to a deeper pullback, potentially back towards the 1.1580 level we saw on the hourly chart. Okay, let's switch back to the daily chart to recap and look ahead. To summarize, the long-term trend since September has been bearish, but the short-term trend over the last 2 weeks has been bullish. The price is now caught between these two opposing forces at a critical resistance level. Let's lay out the most important price levels to watch. Key support is at the recent low of 1.1470, with the major psychological and technical level of 1.1400 below that. Immediate resistance is the zone we are currently testing, from 1.1640 to 1.1650. The most critical resistance zone for a bullish trend continuation is between 1.1747 and 1.1775. So, what are the likely scenarios? I believe the bullish scenario has a slightly higher probability, perhaps around 60%, given the strong rebound from support and the uncertainty surrounding the US dollar. In this scenario, we would need to see a decisive daily close above 1.1650. This would open the door to test the major resistance at 1.1750. This outcome would be reinforced by any dovish commentary from upcoming Fed speakers. The bearish scenario, which I'd place at a 40% probability, would involve a rejection from this current resistance. If we see the price fail here and break back below 1.1580, it would suggest this was just a corrective bounce. This would put the 1.1470 low back in focus, and a break of that level would likely lead to a test of 1.1400. This scenario would be strengthened if Fed officials signal a more hawkish stance. The main things to watch for this week are any statements from Fed members and the weekly closing price. A weekly close above 1.1650 would be a win for the bulls, while a close back below 1.1580 would favor the bears. Trade carefully around these levels. As always, this information is for educational purposes only and is not financial advice. You should always conduct your own research and analysis before making any investment decisions. Thank you for watching Explain the Charts. Don't forget to like and subscribe, and we'll see you in the next one.